Imagine this. You're standing at the starting line of your financial future with zero investments, no portfolio to speak of, and a burning desire to build wealth that lasts. What if you could avoid every pitfall that trips up beginners and set yourself up for success from day one? That's exactly what we're unpacking today on Investment Nisha. Hi, I'm Nisha, and after 8 years of riding the ups and downs of the markets, complete with my own share of costly mistakes, I'm sharing the precise roadmap I'd follow if I were resetting everything right now. This isn't just theory, it's battle-tested advice to help you gain unshakable confidence, steer clear of newbie traps, and pave the way to real financial independence starting today. We'll break it down into 7 actionable steps, each packed with practical tips, real-world examples, and lessons from my journey. Whether you're a total novice or looking to refine your approach, this guide is designed to empower you. So grab a notebook, settle in, and let's transform your blank slate into a thriving portfolio. Let's dive straight in because time is money and we're not wasting any. Before we get to the steps, a quick note on mindset. Investing isn't about getting rich quick. It's about consistent, informed actions that compound over time. Many beginners, including past me, chase hype and end up burned. This roadmap flips that script by starting with the fundamentals and building upward. All right, onward. Step 1, solidify your financial base before you even think about stocks. Here's a startling reality check. Recent surveys from organizations like the Federal Reserve indicate that close to 40% of adults in the United States couldn't cover a sudden $400 expense without dipping into credit, cards, loans, or even selling personal assets. That's not just a dry statistic, it's a glaring warning sign and a recipe for investing disaster right from the get-go. Unexpected life events, such as a car repair that sets you back $800, a home appliance failure like a broken washing machine costing $500, or even a minor medical issue with a $300 copay, can force you to liquidate your investments at rock bottom prices during the market downturn, turning what could have been potential long-term gains into immediate and painful losses. If I were rebuilding my portfolio from absolutely nothing today, I'd treat this foundational step as completely non-negotiable. No opening a brokerage account, no researching stock picks, no dipping toes into ETFs, nothing until this groundwork is firmly laid and secured. It's basic human nature to want to skip ahead and jump right into the exciting parts. You scroll through social media and see viral posts about overnight millionaires who struck it rich with a single stock. Or you hear colleagues at work boasting about their hefty returns from the latest tech boom. And suddenly you're tempted to pour every available dollar into the market, even if it means raiding your meager emergency savings or maxing out credit lines. But let me tell you, that's a fast track to regret and financial setback. Without a solid buffer in place, market volatility doesn't just feel abstract, it feels deeply personal and threatening. A mere 10% dip in the market can trigger full-blown panic selling, eroding not only your principal, but also your trust in the entire investing process. I've lived through it personally. Early on in my journey, I invested impulsively without this base. And when an unexpected bill hit, I had to sell at a loss, which set me back months and shattered my confidence for a while. To build this foundation right and avoid those pitfalls, I'd zero in on 3 core pillars, each with sub-strategies to make them achievable. First and foremost, aggressively pay down any high-interest debt such as credit card balances, retail store cards, or short-term personal loans. Visualize your finances as a lush garden. That high-interest debt is like an invasive weed that's choking out all your potential growth before it can even take root. With interest rates often soaring between 20 and 40% annually, or even higher if you factor in late fees and penalties, it's mathematically impossible for your investments to keep pace and outrun those costs. For context, the S&P 500's century-long average return hovers at around 810% annually after adjusting for inflation. Impressive for long-term growth, but utterly dwarfed by the double-digit drain from consumer debt. To tackle this, I'd employ proven methods like the debt snowball for psychological motivation. List all your debts from the smallest balance to the largest. Continue paying the minimums on everything except the tiniest one, and throw every extra penny you can muster at that smallest debt until it's completely wiped out. Then, roll that entire payment amount into the next smallest debt, creating a snowball effect that builds momentum and keeps you encouraged. Alternatively, for pure mathematical efficiency, go with the debt avalanche approach. Prioritize and target the debts with the highest interest rates first, while maintaining minimum payments on the lower rate ones. Either strategy works, but the key is consistency. Clearing this debt not only frees up your cash flow for future investing, but also boosts your credit score significantly, which can open doors to better interest rates on things like mortgages or car loans down the line. If your debts are scattered across multiple cards, consider consolidating them if the rates are favorable. Look into balance transfer credit cards that offer 0% introductory APR periods for 1 to 18 months, but always watch out for those transfer fees, which are usually around 5% of the transferred amount. And to stay on track, use free tools to monitor your progress. Many budgeting apps can chart your debt decline over time, turning what feels like a grind into a visible victory lap. One important caveat: if you have lower interest debts like student loans at 4, 6%, or a mortgage under 7%, those might be okay to deprioritize for now. Focus your energy on the high rate vampires that are sucking your finances dry. Second pillar, establish a robust emergency fund that acts as your financial safety net. The standard target is 3 to 6 months of your essential living expenses. Think must-haves like housing, rent or mortgage, food and groceries, utilities, electricity, water, internet, transportation, gas or public transit, and basic insurance premiums in a high-yield savings account that's easily accessible without penalties. If your job is stable with a reliable dual income household, 3 months might suffice to cover the basics. But if you're a freelancer, in a gig economy role, or a single earner with dependents, aim higher, perhaps even 9 months or a full year for that extra layer of peace of mind. To calculate this accurately, sit down and tally your burn rate. Add up only the absolute must-haves, skip discretionary luxuries like streaming services, gym memberships, or dining out, and multiply by your target months. For example, if your monthly essentials total $3,000, say $1,200 rent, $400 groceries, $300 utilities, $200 transport, $900 other basics. Then shoot for an emergency fund of $9,000 to $18,000. Place this money in an account that's yielding at least 4-5% APY or more. Online banks like Ally, Capital One, or Marcus by Goldman Sachs often lead the pack with competitive rates and no-fee structures. Why bother with high yield? Because even your safety net can earn passively, adding a few $100s a year without risk. During the 2022 market slump, when stocks dropped over 20%, those without emergency buffers were forced to sell investments at lows to cover bills. But with a fund in place, you can ride out the storm without touching your portfolio. A smart bonus strategy: split your fund into tiers, for instance. Keep a quick access chunk of $1,000 to $000 in a standard checking account for minor emergencies like a flat tire, and park the bulk in the higher yield savings for bigger hits like job loss. Build it incrementally if starting from zero. Aim first for a mini fund of $1,000 to handle small surprises, then steadily add until you hit your full target. If cash is tight, consider temporary side hustles like freelancing on platforms such as Upwork, driving for Uber, or selling unused items on eBay to accelerate the process. And crucially, always replenish the fund immediately after any withdrawal. Treat it like a zero-interest loan to yourself, repaying it as your top priority to maintain that buffer. Third pillar, achieve true income and expense stability to enable consistent, pressure-free investing. This involves a thorough audit of your cash flow so you can commit to monthly contributions without living on the edge or risking burnout. Start by tracking every inflow, your salary, any side gig earnings, freelance payments, or even occasional bonuses, against every outflow for at least 3060 days to get a clear picture. Use user-friendly budgeting apps like YNAB, You Need a Budget, which teaches you to assign every dollar a job, or Rocket Money, which automatically syncs with your banks, categorizes your spends, and even helps negotiate lower bills. These tools will highlight hidden patterns and waste. That seemingly innocent $5 daily latte, it adds up to $150 a month or $1,800 a year. Unused subscriptions creeping up to $50 monthly. The app can flag and cancel them with a tap. Once you have the data, aim to structure your budget around proven frameworks like the 50-30-20 rule. Allocate 50% of your after-tax income to needs, essentials like housing and food, 30% to wants, fun stuff like entertainment, and 20% to savings and investing, including debt payoff if needed. But don't stop there. Build in protective buffers for inflation, which has averaged 3-5% yearly in recent decades. And for those inevitable surprises like rising gas prices or holiday expenses, with stability achieved, determine your realistic monthly investment amount. Perhaps 15% of your take-home pay, or whatever leaves you comfortable after covering everything else. This setup is crucial because it prevents lifestyle creep, where raises just lead to more spending, and shields you from emotional investing decisions. You're committing from genuine surplus, not scraping by out of necessity. To enhance income stability, negotiate your bills aggressively, call your cable or phone provider for loyalty discounts, shop around for car insurance annually to save hundreds, or switch to cheaper alternatives. On the income side, boost your earnings, prepare a case for a raise at work by documenting your achievements, upskill with free online courses on platforms like Coursera or Khan Academy to qualify for promotions, or monetize hobbies like photography or crafting through Etsy. Remember, stability isn't a one-time set it and forget it. Review your budget monthly to adapt to changes like a new job or family addition. Here's some extra advice I drill into my past self. Make financial check-ins a weekly ritual, even if just 15 minutes. Review your spends, celebrate small wins like paying off a credit card, and make micro adjustments. Many apps gamify this process with progress trackers, badges, and reminders, turning finance into something engaging rather than dreadful. And don't overlook comprehensive insurance coverage, health, auto, renters, or homeowners, to shield against major catastrophes that could derail your progress. This entire foundational phase might feel frustratingly slow if you're eager to invest, but it's absolutely transformative. It's not about delaying your wealth building journey. It's about ensuring that wealth actually sticks around and grows without constant threats. Once this base is solid, you're not just dabbling in investing, you're strategically building on unshakable bedrock. Take inspiration from legends like Warren Buffett, who started with simple savings habits and focused on these basics long before amassing billions. Patience here pays exponential dividends later. To make this interactive, what's one specific expense you're planning to cut this month to strengthen your financial foundation? Maybe that premium coffee subscription or an underused app. Share in the comments below. I might feature some of your tips in a future video and turn those common leaks into collective saving streams for everyone. Now, moving on to step 2, crystallize your goals and investment timeline with precision and purpose. It's genuinely shocking, but a comprehensive survey conducted by the Financial Conduct Authority involving 10,000 investors revealed that fewer than 33% have clearly defined long-term aims when they start investing. Far too many people dive in blindly, influenced by fleeting trends, social media hype, or vague peer pressure, downloading trading apps and scattering their funds across random picks without any real purpose or direction. The inevitable result? When market volatility strikes hard, doubt starts to creep in, fear takes over, and they exit their positions prematurely, completely missing out on the powerful magic of compounding over time. If I were restarting my investing journey today from scratch, I'd begin with deep introspection to answer the fundamental question, why am I investing in the first place? Getting specific here is key. These aren't just vague dreams. They need to be concrete motivations that drive your decisions. For example, is it to retire comfortably at age 55 with $2 million in the bank to fund global travel and hobbies? To save for a child's wedding in 10 years that might cost $30,000? To launch a side business or buy a rental property in 5 years? These detailed goals don't just provide motivation. They directly guide critical choices like your risk level, the types of accounts you select, and your overall strategy for handling market ups and downs. For instance, if your goal is aggressive growth for early retirement, you might lean toward higher risk equities like growth stocks. But if it's something more conservative, like preserving capital for a near-term home purchase, bonds or stable funds would be more appropriate. While you're at it, assess your personal risk tolerance honestly. Could you stomach a 20% portfolio drop without losing sleep? Or would that keep you up at night? Free online tools like Vanguard's Investor Questionnaire or Fidelity's Risk Assessment can help quantify this. Also, factor in your current life stage if you're in your 20s or 30s with decades ahead. You can afford higher risk for potential higher rewards, but if you're approaching retirement in your 50s or 60s, the focus shifts to preserving what you've built. Next, categorize your goals by their time horizon to decide where your money should go. For short-term objectives, anything under 5 years, such as a house down payment, a dream vacation, or a new car, keep that money in low-risk, liquid options like high-yield savings accounts, certificates of deposit, CDs, or money market funds. Why? Because financial markets can be wildly unpredictable in the short term. A sudden crash could halve your savings right when you need it most, turning a $20,000 goal into $10,000 overnight. On the flip side, for medium to long-term horizons, 5 years or more, like retirement savings, college funds for kids, or building generational wealth, that's where investing in the stock market truly shines. Time is your greatest ally here, as it mitigates risk and allows for recovery from downturns. Historical data backs us up. Equities have historically returned 7.10% annually after inflation over extended periods. Let's look at some compelling numbers for perspective. Since the year 2000, an investment of $2,666 in a global shares index fund grew to an impressive $4,926 by 2025, factoring in dividends and growth. The same amount parked in a standard cash savings account, it only crept up to $1,714 over the same time frame. That's a massive performance gap, highlighting why long-term money belongs in investments rather than languishing in low-yield cash. But always adjust these figures for inflation to get the real picture. Nominal returns might look great, but purchasing power is what counts. To make your goals actionable and trackable, frame them using the SMART criteria: specific, what exactly; measurable, how much; achievable, realistic based on your income; relevant, aligns with your life; and time-bound, by when. A strong example: save $50,000 for a home down payment in 7 years, assuming an 8% average annual return by investing $400 monthly into a diversified fund. Use free online calculators like those from Bankrate or NerdWallet to back solve the required contributions based on your expected returns and timeline. Document everything in a dedicated notebook, spreadsheet, or app like Goal Tracker, then set calendar reminders to review them biannually, tweaking as needed for life events such as a job promotion, marriage, or the birth of a child. If your goals involve partners or family, have open discussions to align visions and avoid conflicts later. A powerful mindset tip: visualize your success vividly. Create digital mood boards on Pinterest with images of your dream retirement beach house or family vacation. Or use daily affirmations like, "My investments are building the life I envision." These goals serve as your emotional anchor during market dips. When stocks tumble 15%, remind yourself this volatility is temporary. My investment horizon is 20 years, and history shows recoveries. Watch out for common pitfalls like overambition, setting unreachable targets that lead to frustration, or underestimating costs, forgetting to factor in taxes, fees, or inflation. If you have multiple goals competing for funds, prioritize ruthlessly. Always handle emergencies and high interest debt first, then allocate to the most time sensitive or high impact goals. I've got an upcoming video that dives even deeper into matching specific asset classes to your unique life goals and timelines. It's going to be loaded with case studies and portfolio examples. If that sounds useful, hit subscribe right now so it pops up in your feed when it drops. And to keep things engaging, comment below with your top investing goal for 2026. Is it becoming debt-free, making your first stock purchase, or something bigger like starting a college fund? Let's inspire each other. Your stories truly fuel this community and help me tailor future content. Step 3, choose the optimal investment vehicle that aligns with your goals and maximizes efficiency. The overwhelm in this step is very real, with a seemingly endless array of options, from traditional brokerages to robo-advisors and tax-sheltered accounts. Beginners often get stuck in endless research mode, reading article after article without ever taking action. But once you've nailed your financial foundation and clarified your goals, the process simplifies dramatically. Select the right account type, open it quickly, and start funding it consistently. If I were crafting my fresh start plan today, here's how I'd prioritize based on my situation. If I'm employed with a steady job, I'd first maximize any employer-sponsored retirement plans like a 401k or 403b for nonprofits. These are often gold mines because many companies offer matching contributions, which is essentially free money on the table. For example, a common match is 100% on the first 6% of your salary you contribute, turning your $3,000 input into $6,000 instantly. The tax perks are huge too. Contributions are made pre-tax, reducing your current taxable income, say dropping you from a 22% bracket to 12% and saving hundreds in taxes. And the growth inside the account is tax deferred until withdrawal. However, the downside is accessibility. The funds are generally locked until age 59.5 to avoid penalties, making this ideal for long-term retirement goals rather than shorter-term needs. Always contribute at least enough to capture the full employer match. Anything less is leaving money behind. Also, understand your plan's vesting schedule. Some company matches cliff vest after 2-3 years of service, meaning you own them fully only after that period. So factor in job stability for self-employed individuals, freelancers, or small business owners without an employer match. I'd opt for alternatives like a solo 401k or a CEP IRA. These allow for high contribution limits up to $69,000 or more in 2026, depending on income, and offer similar tax deductions on contributions. Roth versions of these plans let you pay taxes upfront but withdraw tax-free in retirement, which is great if you expect to be in a higher tax bracket later. For even simpler setups with employees, a simple IRA provides easier administration and lower costs. Research which fits your business structure using IRS resources or a financial advisor. Next up, I'd layer in tax-advantaged accounts for broader investing. These are game changers because they shield your gains from taxes, supercharging compounding. In the US, a Roth IRA is a top choice. You contribute post-tax dollars, but all future growth and qualified withdrawals are completely tax-free. The 2026 contribution limit is $7,000 if under 50 or $8,000 if 50 plus. But check income eligibility. High earners might need a backdoor Roth strategy. Converting a traditional IRA to Roth, gains inside can be untaxed forever, potentially adding 2030% to your long-term returns through tax savings alone. Internationally, explore equivalents like Canada's tax-free savings account, TFSA, which allows tax-free growth on any investments, or the UK's individual savings account, ISA, for similar benefits. Always research your country's specific options. As tax laws vary widely, the principle of tax efficiency can compound hugely over decades. For education-specific goals, a 529 plan offers tax-free growth when used for qualified expenses like tuition. For more flexibility outside retirement, a standard taxable brokerage account works well, but I'd prioritize low-fee platforms like Fidelity, Vanguard, or Charles Schwab. These offer zero commission trades, the ability to buy fractional shares, so you can invest $50 without needing a full share price, and diverse investment options from stocks to bonds. When comparing, focus on expense ratios under 0.1%, robust educational resources for beginners, and intuitive mobile apps for on-the-go management. If you prefer hands-off, consider robo-advisors like Betterment or Wealthfront. They use algorithms to build and rebalance portfolios based on your risk quiz answers, often for fees under 0.25%. The opening process is straightforward and can be done entirely online in minutes. Provide basic ID verification, like SSN and address, link your bank account for transfers, and confirm via email or text. Start with a small initial deposit, say $100, to get familiar with the interface without pressure. It just so did the progress to say that SIP for the different tags to the peoples and the rest of the peoples. Prioritize security features, enable two-factor authentication, set up alerts for unusual activity, and review statements monthly to catch any issues early. If there's a barrier holding you back here, comment below what's stopping you. Confusion over all the options, fear of hidden fees? We'll brainstorm solutions in the replies. Knowledge is power, and starting small demystifies the whole thing. Step 4, launch small, but prioritize regularity and let compounding do the heavy lifting. This step often blows people's minds with its simple yet powerful math. If you invest just $100 every month at an average annual return of 8.10% based on the S&P 500's historical performance over 1020-year periods, after 30 years, you'll have over $140,000 in your account. And here's the kicker. Only $36,000 of that total comes from your own contributions. The remaining $104,000 is pure profit from compounding. It's like a snowball rolling downhill. Your money earns returns, those returns earn their own returns, and the growth accelerates exponentially. To break it down, in year 1, your $100 grows by 8% to $100 and $8 in interest. In year 2, the full $108 grows by another 8% to $116.64, now earning on the original plus the previous gains. Fast forward to year 20, that same monthly habit could turn $24,000 invested into around $57,000 total, with compounding responsible for over half. Despite this potential, fear and barriers hold many back. A Barclays study found that 44% of non-investors cite a lack of knowledge as their main hurdle, while 41% worry about losing money. To counter that, start with micro-investing. If $100 feels daunting, begin with $20 weekly or even $10 bi-weekly. The key is building the habit over chasing big amounts early on. This approach leverages dollar cost averaging, where you invest a fixed sum regularly, regardless of market conditions, buying more shares when prices are low and fewer when high, which smooths out your average cost over time and reduces the risk of bad timing. For example, if a share is $50 one month, your $100 buys 2. If it drops to $40 next month, you get 2.5. Over time, this averages favorably, Track your progress using free apps like Acorns, which rounds up purchases to investor change, or your brokerage's dashboard. Seeing that snowball form visually is incredibly motivating. And remember the big picture. Markets have always risen long term, with the S&P averaging about 10% yearly returns, but yearly variance can be wide from plus 30% booms to minus 20% busts. So patience is essential. Don't let short-term dips deter you. They're normal and often the best buying opportunities. If this math and strategy is motivating you, smash that like button. It helps the algorithm share this with more beginners. And if you're not subscribed yet, do it now for more weekly breakdowns like this. Your support directly grows this channel and lets me create even better content. Step 5. Diversify strategically to spread risk and capture balanced growth. Think of your investment portfolio like planning a well-diversified, nutritious diet. You wouldn't load your plate with only one food group, like all carbs or just proteins, because that leads to imbalances, deficiencies, or crashes in energy. Similarly, putting all your eggs in one basket with investments is risky. If that single asset class tanks, your whole portfolio suffers. During the 2008 financial crisis, for instance, banking stocks plummeted over 50%, but portfolios diversified across sectors held up far better. To keep it simple and effective, if starting fresh, I'd skip the complexity of individual stock picking, which requires hours of research and often underperforms the market, and instead pour my funds into low-cost index funds or exchange-traded funds. These are baskets of investments that track broad market indices like the S&P 500, which includes 500 of the largest US companies across diverse sectors, from tech giants like Apple and Microsoft to healthcare leaders like Pfizer and Johnson & Johnson, finance powerhouses like Procter & Gamble and Coca-Cola. With just one fund, you get instant exposure to hundreds or even thousands of companies, spreading risk so that if one sector, like energy, slumps due to oil prices, others like technology might boom to offset it. The beauty of index funds, they're passive, with ultra-low expense ratios, often around 0.04%, compared to 1% or more for actively managed funds. And data from the S&P SPIVA report shows they outperform 90% of active funds over 15-year periods. Why? Professional managers rarely beat the market consistently after accounting for their fees. For allocation, tailor it to your age and risk tolerance. If young with a long horizon, go 80-90% in stocks for growth potential. As you age, shift toward 20-40% in bonds for stability. Add global exposure to funds like Vanguard's Total World Stock ETF hedge against US-only risks by including emerging markets for extra growth. Rebalance your portfolio annually, sell off portions that have grown too large, locking in gains, and buy more of the underperformers to maintain your target mix. Real-world example, in the 2020 COVID market crash, diversified portfolios fell less sharply, around 230%, and recovered faster than those heavy in travel or retail stocks, rebounding to new highs within months. Common pitfalls to avoid: over-diversification, where you spread too thin across dozens of funds and dilute your returns. Aim for 3-5 core funds to start, or recency bias, chasing last year's winners like hot tech stocks. History shows trends reverse. Use tools like free portfolio visualizers on sites like Portfolio Visualizer to simulate different allocations and see historical performance. Step 6. Automate for hands-off wins and emotional protection. Here's a quirky but telling stat from Fidelity Investments. Their highest performing client accounts over a decade belong to people who'd either completely forgotten about them or, unfortunately, passed away. The takeaway? Less interference often leads to better results, as constant tinkering based on news or emotions typically hurts returns. Studies show active day traders underperform the market by about 1.5% annually on average due to fees and bad timing. if rebuilding today, I'd automate absolutely everything to remove human error from the equation. Set up automatic transfers from your checking account to your investment account, timed right after payday so the money is invested before you can spend it. This enforces the pay yourself first principle. Most platforms like Vanguard or Fidelity make this easy with recurring investment options, allowing you to specify amounts and dates, weekly, monthly. Enable automatic dividend reinvestment too, by payouts from your funds, buy more shares without you lifting a finger, further accelerating compounding. If using a taxable account, turn on tax loss harvesting features available on robo-advisors to automatically sell losers and offset gains for tax savings. This automation shields you from your own emotions. No more debating, is now the right time to invest during elections, recessions, or hype cycles. It just happens. You'll avoid FOMO, fear of missing out, buys at peaks, or panic sells at bottoms. Instead, focus your energy on life while your wealth builds quietly in the background. For a quick hack, what's one automation trick you've implemented or want to try in your finances? Auto bill payments, roundup savings, share in the comments below. Let's exchange ideas and build a thread of tips. Step 7, build resilience to stay calm and invested during market dips. Over the past 150 years, the stock market has endured 19 major crashes, each one feeling like the apocalypse in the moment. Yet, without fail, it has not only recovered but surged to new all-time highs afterward. Historical charts from sources like Morningstar show these steep red drops amid wars, pandemics, inflations, and bubbles as mere blips in a long upward trending line. The 1929 Great Depression erased 89% of market value and took 25 years to fully recover. But patient holders who stayed invested ended up winning big as the economy rebuilt. The dot-com bubble burst in 2000, wiped out 49%, but the market climbed back. The 2008 global financial crisis saw a minus 57% plunge, followed by one of the longest bull runs in history. And the 2020 COVID crash dropped minus 34% in mere weeks, yet snapped back in just months, marking the fastest recovery ever. Early in my investing days, every minor dip had me panicking and questioning if I'd made a huge mistake. Now, I view them as temporary sales, opportunities to buy quality assets at discounted prices. Your earliest steps in this roadmap equip you perfectly for this. A strong emergency fund prevents desperate sells. Clear goals remind you of your long horizon. Consistent investing via automation keeps you buying low. Diversification mutes the impact of any one area. To build even more resilience, adopt these strategies. Educate yourself with timeless books like The Psychology of Money by Morgan Housel, which unpacks behavioral biases. Limit news consumption to once a week to avoid hype-driven reactions. Set app limits if needed, and seek community support through forums like Bogleheads or Reddit's r/personal finance for encouragement during tough times. Always zoom out for perspective. A $10,000 investment in the S&P 500 back in 1970, through all the crashes and booms, would be worth over $2.5 million today. That's the power of staying the course. In recap, this from-scratch blueprint covers solidifying your base with debt payoff, emergency funds, and cash flow stability, crystallizing goals and timelines, selecting optimal accounts, launching small but regular investments, diversifying strategically, automating for consistency, and building dip resilience. Action always beats waiting for perfection. Start today and let compounding work its wonders. What's your biggest rookie investing regret you'd redo? Or your top question like, what's the best starter index fund? Drop it in the comments, engage, because your input directly shapes future content. Thanks for joining me on Investment Nisha. Catch you in the next one.